Hey, everybody. Thank you all for staying late. I know it's late. It was just an incredibly busy day with everything that's going on. And we started early. Everything that's going on for obvious reasons. A lot of action to be happening. We're going to talk about the wild ride that was today, triggered by CPI and a lot of other factors behind the scenes. So let's jump in. Big thank you to the mods as well there in the chat. And also, quick reminder, DCA tomorrow is at noon Pacific on my channel. That is circa 21 hours from now. So Ben and Rob will be here. So, and as usual, not financial advice, just edutainment. Well, the story looks like this. This is what happened when they announced the CPI. 0.1%, a little bit higher than expectations. And of course, the market freaked out. It's like, oh no, this is what the Fed needs. But you know what people forget then immediately afterwards is everything is priced in. 0.1% doesn't matter. It clearly shows, once again, the Fed has no control. They take their blunt instrument, smash the economy. The Fed can't control inflation because they're looking at data from ages ago. So when you compare a rent change last month to rent price a year ago, again, it's silliness. But anyway, this is the action from TradingView of what the S&P 500 did at the open on the left. Second to the left is what gold did, what the euro did, and of course CPI. Oh no, S&P 500, gold, Bitcoin, and then the euro after the CPI hit. So that's the sequence. Everything wicked down, but that's not the interesting part. This is crazy. So the S&P 500 fell 3.5%. Okay? Absolute fell out of bed, went down under 3,500. And as you know from this channel, if you've been listening to me, 3,500 is when I said money was going to start deploying. Boom. And boy, did that happen at 3,500, right on the nose. In fact, we went to about, I think, 34.85, 15 points under 3,500. And then the market shot up 5%. So down 3.5%. Up 5. That's a big swing. A lot of fun to be had there. But why did it happen? Let's dig into the reasons, because it's important to know what causes it. Well, it was a perfect cocktail of not only, as I said, the 3,500 S&P was a trigger for many administrators of large amounts of money to deploy, but also a little bit of short covering. A lot of people were short. There was a lot of people who had sold puts, and they needed to balance those out, either cover them, sell them, etc. Again, the huge wave of put options that was bought to protect against this rout moved into the money. Therefore, the profits were booked in most cases. And that prompted those who had them to buy stocks to go back to being market neutral. Also, insider buying. Insider buying, well, we'll talk more about that. And some very tasty entry points. So a lot to cover today. So first of all, I'll give you an example of a tasty entry point. Tesla was trading today at a PE of 36. I'm working on a model that looks at their global production numbers over the next 5 years. If anybody's interested in seeing that new Tesla model, drop a comment below and I'll do that video tomorrow or Saturday. But these are tasty entries. This PE price of Tesla we have not seen since 2019, and it hit also during the COVID fall in March 2020. Again, a crazy opportunity to buy a stock at a really good price. It fell just to about, I think, 205, 204, 206. I can't remember the exact number. But it was such a busy day, my head is frazzled. And this Bloomberg screen with the 36 PE is from Gary Black. And again, he thinks the Tesla board should be buying its stock because they've got 18 billion in excess cash to deploy and their stock is cheap. So he sees it as a 24% IRR by just buying the stock in a very short window of time, guaranteed for Tesla to buy. And that's what companies are doing now. Their stocks are so beaten down. Those stocks that aren't zombies, which are 40 to 60% of the S&P 500, but the ones that aren't, insiders are buying. And this is from Jurian Trimmer, and a big thank you to Sanjay for sharing it with me. And it's basically a look at who's bullish. And these are corporate insiders who are buying their own company stocks again and during this latest sell-off. And as the saying goes, insiders sell for all kinds of reasons, but they only buy for one reason, and that is their stock is dirt cheap. And given the historical accuracy of their timing, it's a very positive sign. So again, not all insiders are buying, but those within good companies are. So again, it's not about having the index, it's about having the right assets within the index is critical. Let's jump a little bit forward. Again, per JT, not Justin Timberlake, Jurian Trimmer, of course, from Fidelity. He actually mapped out all of the recessions of the S&P 500, and assuming a start date, you can see where they all wound up. Now, it is far from a uniform pattern. And in the chart you see, recession, I believe, have done for a long time, recession is imminent. But I also believe it started 2.5 quarters ago, not now. But this black line here on this chart from Jurian says the start of the recession is in September. But the point is not really just to look at the action, but look at the trajectory of all the recessions over history and where they've gone in the subsequent period. And the majority are up and to the right. So again, this follows my thesis that the bottom of the stock market is typically in 1/3 the way through the recession. Again, the market forecasts. It identifies where the puck is going to be. Therefore, it prices things out very, very fast. So great work there from JT. Now, a weird thing happened. I haven't seen this in a long time, but you saw a crazy Bitcoin ETH correlation during the breakdown. Bitcoin was up 1%. It's about 19,400 now. And Ethereum fell to 1287. And last time I checked, it was exactly there too. So one goes up 1%. Remember, it was a very violent day. And the other one falls 1%. That is not usual. These two normally are in lockstep with each other. So what's going on? So let's look at the ETH Bitcoin pair. You can see it tanked from 0.068 and change to 0.066, and it was at 0.08 not too long ago. In fact, it was above it during pre-merge price action. But that's a 3% difference in a day on this pair, and that's a big move. So something's going on with Ethereum, and we have our theories. One of them is people are going to other layer ones that are eating the lunch of Ethereum. You've heard me talk about that for a long time. But the other factor, I think, is this, and this is very important. This is decoupling from ETH. One of the catalysts, I believe, is this Bitcoin catalyst. And Michael Saylor was sharing news on the FASB, which is the Financial Accounting Standards Board, who actually is a unit of the SEC. And they said they can now use fair value accounting for measuring Bitcoin and other cryptos. And this is a huge milestone on the road to institutional Bitcoin adoption. And as I said here in my tweet yesterday, I think it was, nice work, Saylor. But with all that's going on in the fiat world, this was one item that prevented a ton of adoption, and it probably triggered Tesla's sale. Speaking of Tesla again. And now that Bitcoin is so undervalued, under realized price, that's what RP is for, I expect some new Bitcoin treasuries to hit before Christmas. And again, yet another domino falling. Good news for Bitcoin. Should have impacted Ethereum too, but it didn't. But I think this is probably what's happening. And it would not surprise me. I expect at least a couple of new treasuries before year end, but it wouldn't surprise me if a couple said, whoa, hang on. Bitcoin's at 18 and change. Why not get a couple? Who knows? And I know a lot of small businesses that have some Bitcoin on their balance sheet. Now, this is a cool little chart. And per Ki Jung Yu, he is the head of CryptoQuant. He said institutional adoption could happen in very soon or in a year or two. But if you look at the crypto market cap divided by M1, which is the money supply, crypto adoption in asset allocation, it's very important. Just to zoom out for a second. When you look at any asset you've had over the past, say, 10, 20 years, 5 years, and you divide it by the growth of money supply, if it's not above 0%, you're losing money. You don't want to be in those assets. And there's very, very few assets that are positive when you divide them by the growth of money supply. The ones that are actually are the ones that I tend to be in. So remember that, everybody. But here, if you look here, the first big run for crypto and Bitcoin was because there was adoption by retail investors because of the emergence of global crypto exchanges. The second big catalyst, which is going to be a lot bigger than retail investors, and this will be the adoption by institutional investors thanks to the emerging global institution-grade infrastructure. And that's coming fit, fast, and furious. I talked about Bank of New York Mellon yesterday, all the other banks that are in there, Fidelity we just touched on, Sailors, FASB tweet. It's all lining up. I know it still may take a little bit of time, but it's coming, ladies and gentlemen. But there's more. Let's look at the market. This is those in green today. Bitcoin, Binance, and of course the stable coins, Uniswap, FTT, CRO, etc. The rest is kind of red. So Bitcoin did really good today. But as I've always said, Bitcoin tends to lead the market and then the rest follow. So I expect bumps from some of the layer ones and others to happen tomorrow over time. Let's look at the stocks. This is very interesting. Stocks like Amazon were down because apparently the second Amazon Prime Day kind of fizzled out. Baba was down. I'll talk more about reasons behind that. It's like every time you look at crypto and stocks and all the different unique players, you will see insights to everything. So Amazon sales are down. They were forced to do a second Prime Day. Sales sucked. What does that tell you? There's no consumer confidence. People are sitting at home, sitting tight, weathering the storm. And that's very telling. But we'll talk more about that later. Now, in other good news, half of young Americans invest in crypto. And this is a Bank of America study. And basically, the quick summary of it is those under 43 years of age, 47% have Bitcoin and crypto. And those over 43 prefer equities. I happen to be over 43 and I like both. But I thought that was extremely telling. And I have no idea where they come up with the age 43. It might just be the mode where most people exist or where the majority are split above and beyond those with money. But I thought that was cool. So if you are under 43 or over 43, I'd love to know. I think the average age of the viewer of this channel is about 35, which is a good chunk younger than me. But anyway, I'm glad you're here. Let's look at this one. This is so far a ticking time bomb that everybody thought would blow up the crypto industry. And now the risk is gone. So kudos to the team at Tether. What they did was they reduced their commercial paper to 0. And now they have T-bills, US T-bills. And this announcement comes as part of Tether's ongoing efforts to increase transparency with investor protection at the core of what the management wants to do. And you can see how they've accelerated in doing this. The red is their commercial paper, gone to 0 since basically September 2021. And that's a big change. And now what they have is US Treasuries, commercial paper. It's also interesting because people think, oh, look at me. I'm parking my money in Tether. Good. But when you park your money with them, they're now earning up to 4% on US Treasuries on your money. So make sure you're getting at least 4% when you do park your money for any type of time, significant time. That's an important thing to bear in mind too. In addition, speaking of Bitcoin and dominoes falling, Lawrence Lepard, an academic, great guy in the space, veteran investor, he says he warns we are in the end game of fiat money. And he says Bitcoin will take the stage. And he said the Fed is losing it. He said, and these are his words, basically words to the effect of they completely blew it on transitory. They blew it on printing too much money. They were too late to raise rates. Inflation is running red hot and they are scared and they have no control. But he said, I think it's obvious that Bitcoin is going to become a dominant form of money. He said it's a Michael Burry moment. I think in the next 18 months, we're going to see the United States experience a full-fledged currency crisis. And when it does, the Fed is going to have to come back in. And Powell will either resign or be fired. So I saw them as being very, very strong words from him. But yesterday, coincidentally, I did a video on exactly how I believe the dollar could come crumbling down. And that is, once the petrodollar goes away, which is going to happen, I'm pretty convinced, you'll see big changes within the dollar as well, especially for international trade, because I think about 90% of all international trade is denominated in dollars right now, and that's going to change everything. So let's switch gears to crime, crypto crime, in fact. And there's a lot more news to come, but I'll go through this very quickly because a lot of people are asking, oh, what about the Solana hack and da-da-da. So we'll touch on that. But basically, in October alone, $718 million was stolen from DeFi protocols. And at this rate, 2022 will be worse than 2021 for the biggest year on record. And the hackers have pulled in over $3 billion, according to, I can't remember the name of the firm, Chain Analysis. They came up with this information. But why am I talking about crime? Well, it's important. First of all, it's important if you use DeFi. You got to be very, very careful. But Mango Markets was hacked, and Mango Markets is built on Solana. So people get confused. This is a hack of something that was built on Solana, not a Solana hack. And what the hacker actually did was they modified, tweaked the oracles to give wrong information. So it's not even something to do with Mango. Mango relied on oracles to make decisions in a market platform. And it was not a flash loan attack. And the attacker addresses were funded, unfortunately, by about $6 million from FTX. So I'm sure Sam isn't very happy. And the attacker manipulated prices across all exchanges, not just Solana oracles. So this guy was very smart, very orchestrated, very contrived, and that's how it happened. So there's nothing wrong with the blockchain Solana itself. But again, these DeFi hacks are happening all over the place, and the hackers are getting smarter and smarter. Now, when Sam was asked about this, he was none too happy. He said, make up your own damn mind as to what's going on. Obviously, FTX was a little bit tarnished because the hacker used funding from FTX to do it. And he said, really, to unpack the lessons, basically, DeFi oracles are in his crosshairs. And when it comes to oracles, you just have to make up your own damn mind. So the oracles are the problem here. Obviously, the biggest and best one in the business is Chainlink, and they're rock solid, but there's a lot of other ones emerging. And again, that's where the problems are now existing. So watch that space carefully and be careful. But let's dig into some crime information, transaction volume. Again, this is from Chain Analysis, and they said transactions involving illicit addresses represented about, I think, 0.15% of cryptocurrency transactions in 2021, despite the raw value of illicit transactions volume reaching its highest ever. So again, it's big, but it's not everything. 0.15% is quite low. And where does all the action happen? Well, there are couple of categories that stand out. We're going to look at stolen funds here. And you can see here stolen funds are back up again. They were up in 2018, that big green bar in the 2018 chart, and again in 2021. And what's happening here is the year-over-year growth is 600%. So 2021 was a great year for the scammers, stealing funds from people. And it rose 82% in 2021 to about $7.8 billion worth of cryptocurrency stolen from victims. And you're out there every day, and people still say to me, as somebody said the other day, I'm upset with you. You took money from my girlfriend. It's like, no, that's not me. I won't reach out to your girlfriend. I won't nurture a relationship with your girlfriend. I will not take money from anybody. It's not me. It's a hacker. It's a scammer. So just remember, everybody, I will never reach out. Rob will never reach out. Ben will never reach out. None of us have any time, okay? So if somebody's saying something to you or schmoozing you, you know it's not us. It's a hacker. And they've taken $7.8 billion from people in 2021. So just be careful. Lock down your security. Check out my video from last Sunday on how to lock down your personal security. And we'll do more of that too because it's very well received. So it's just plain old theft. Don't be scammed, okay? Next, DeFi. The other big area where a lot of money is taken in 2021 is that big blue block, and that is all DeFi. A 335% increase in money stolen over 2019, and another 1,330% in 2021 over 2020. In other words, DeFi has continued to grow, and so too has its issue with hacks. So everybody be very, very careful when you're playing on DeFi. It is a dangerous place to be. Do your stuff. Get off. Get to safety. But again, it's the Wild West. Let's switch gears. Talk about some impact of CPI and interest rates and everything else. This is a Bloomberg article. And it says U.S. mortgage rates near 7%. A warning that they could go much higher. And this is an economist called Yoon. He says that he believes 8.5% is the next stop. Now, I remember like over 22, 23 years ago, I was doing mortgages. And I remember scoring, it was like a 6.25% mortgage on a non-conforming loan. And that was a deal back then. But that's nearly 25 years ago. And now we're higher than mortgage rates back then. So it's crazy. If we go to 8.5%, that will crush the real estate market. But it's not just people buying and selling houses. It's the people building the houses, the whole home building industry, which contributes 35-40% to GDP in this country. So it's a big, big industry. All the cottage industries that go behind it, it is huge, and it's a problem. So again, I hope it doesn't happen. I hope Mr. Yun is wrong, 8.5%. But if we do get near 8.5%, that's going back to mid-90s levels of mortgage rates. So let's talk about job switchers. For those of you who are sitting in your job and you don't like it, and you think you can do better, well, I'm not saying go quit your job. Don't quit your job till you have a better one in the bag, and make sure you have it signed, sealed, and delivered. But workers who switch their jobs got a pay increase of 7.1%. over those last year who stayed in their jobs got only 5.2%. And this is data going back to 1997. This is the widest gap ever seen. So those thinking about switching jobs, it pays, not job or career advice. Next, let's talk a bit about chips. NVIDIA has been smashed by the US sanctions, but let's talk about this for a second, because in this title here, US chip sanctions kneecap China's tech industry in a very bad way. And of course, the chips that NVIDIA make are used for AI, but it's designed to kill China's military ambitions. But it's also hurting a lot of the local technology companies like Baidu and I can't remember the other one. Forget it. The Google of China. Maybe that is Baidu, but there was another one too. But anyway, the point is these guys are no longer able to build out the technology because they don't have the chips to do so that they had in the past. And this could really cause a lot of pain. Obviously, a lot of the chip companies are in places like Taiwan and South Korea, and I don't see the Taiwanese avoiding or running around these actual sanctions from the US. But again, it is hurting not only the companies, but it's also hurting China in a big way too as we go forward. And the final piece of news for today is energy. And a big thank you to Sanjay for sharing this with me too. These are the energy sources from Europe. And this kind of blew me away because energy is what's hurting people most right now, the cost. But if you look at that little red mark in the middle, nuclear, France. And that is the most consumed energy source per country. And most people in France use nuclear energy. And it's also considered one of the cleanest ones. Of course, it can be very dangerous if something happens to it. But anyway, I was surprised to see so many countries running on oil. Spain, Portugal, Ireland, Germany to a large extent, etc. Very shocking. Renewable, very little except for Scandinavia. And then hydroelectric, you see the light blues. I don't see any of those actually, except for, Scandinavia. And the renewable is Denmark, sorry. Got my colors mixed up. And natural gas being the UK, Russia, Italy, etc. And of course, a big chunk in Germany too. So I thought that was super interesting, a quick snapshot of how Europe runs and how they're all going to cope. And hopefully it's a lesson for the future that some people say, don't take the advice from a 16-year-old, but think about long-term energy independence as we go forward. And we've all learned a lot this year. So that's all. See you tomorrow, everybody. 12 noon. That is 12 hours. I think that is 7 p.m. UTC, 8 p.m. mainland Europe. Thank you to the mods in the chat. Thank you to 2,500 lovely people watching. I'll see you all tomorrow. Have a good night.